Hey guys, it's Investing with Noah, and I'm here with my second video. This video is going to be on options pricing and the Greeks. These Greeks are delta, gamma, vega, rho, and theta, and in this presentation we'll also be covering implied volatility. If you haven't seen my first video, please go check it out before you watch this one, as it's going to give you a lot of important background information. Okay, so first we're going to be talking about the importance of options value. Last video I talked about exercising options, but retail traders rarely do this. Generally, instead of buying 100 shares of an option, which costs a lot of money, retail traders would just sell the contract for more than they paid for, or less than they paid for, depending on if the stock went in their favor. For example, if you bought a contract at 50 cents, and then the same contract is being sold at $1, if the price of the contract is increased, you could turn your $50 investment into $100. This percent gain is generally a lot larger than what you would have if you actually exercised the option. You can use the options value to capitalize on spikes in price, especially right after you buy. So if the stock goes way in your favor, if you bought a call option and then Apple stock, for example, rises $10 the next day, as it's up about 6% today, you could sell your option for a massive profit. A lot of Apple options currently are between 80% and 100% increase. And that's a perfect example of how options can leverage your position. Instead of going up 6% like Apple did today, the value of the options went up 80 to 100%, or sometimes even more, depending on what strike price and what expiration. Generally, you can use your information available to try to sell overvalued options. You can sell options to other people that are valued too highly, or buy undervalued options. An options value is determined by the Greeks, and as we'll talk about in the next slide, it's comprised of two main components. These two components are the intrinsic and extrinsic value. Options have an intrinsic value when they are ITM, in the money. This means that they could be exercised for a profit. For example, if you have a call that's below market value, this would be like if you had a call for $40 and the market price was $42. If you exercised the call, you could buy 100 shares at $40 and then sell them at market for $42. Therefore, this call is in the money. Another example would be a put that is above the market value. A put is the ability to sell. So if you had the ability to sell shares for $50 when you only had to buy them at, let's say the market value was $45, you could buy the shares for $45 and then immediately sell them for $50 using your put option. The extrinsic value is the time value, and this reflects the chance of an option becoming in the money or more in the money by expiration. So if you have 2 weeks left, there's a higher chance of the stock increasing or decreasing to make your option more in the money, if it's a call increasing more or a put decreasing more, compared to if you have an option that only has a day left of time, as there's a smaller chance of the value of the stock moving a large amount. For example, if there's a $40 call being traded for $8 on a $45 stock, the intrinsic value would be $5, because you'd be able to buy the stock for $40 a share and sell it for $45 a share, making $5 in profit. The extrinsic value is $3. This is comprised of the time value, and this value of the call as a whole, and especially the extrinsic value, is determined by a series of factors known as the Greeks. The Greeks are delta, gamma, theta, vega, and rho. We're going to cover each one individually. Delta is the change in option value for every $1 change in stock price. Let's say the delta of an option was 20 cents. That means every dollar that the stock moves, the value of the option would increase by 20 cents. As you can see at the bottom, stock has a delta of 1. Whenever the stock price increases by $1, the value of your position increases by $1. Then the question becomes, why would you actually buy an option when you can make potentially more money if you just own the stock? The answer is that if you had an option that you purchased for $2, which remember is $200 because it's multiplied by 100 shares, and the value of the stock goes up $5 with a delta of 10 cents, then not taking anything else into account, the value of your option would increase by 50 cents, which would be around 25%. Chances are that the increase in stock price was not equal to 25%. This is another example of how options are leveraging your position. Let's go on to the next Greek, gamma. Gamma is the change in delta for every $1 change in stock price. It is the change in delta. It's mistyped there. So this means that, let's say the value of the stock goes up by $1. the delta will go up by the amount of gamma. This means that as the stock price increases, the value of the delta increases exponentially. This is why when you have an option that is very far in the money, the delta will be very close to 1. Let's think about why this makes sense. If you have Apple stock, which is trading at $290 a share, and you have a call option for $1, you're able to buy the Apple stock for $1 and then sell it at $2.89. So the premium is going to be very high. But at the same time, every time Apple changes by $1, you would expect the premium to also change by $1. Because if you're paying $290 in premium for the option, you wouldn't expect it to just go up by 10 cents. You expect it to go up by much more because you're paying a lot more for that option. Theta is the decrease in option value every day. The reason I have day in parentheses is because it's really just a time unit, but generally day is the accepted time unit for all options. Vega is the change in option price for every 1% change in implied volatility. We'll go over implied volatility later in the presentation. Finally, Rho is the change in option price for every 1% change in the interest rate. For short-term options, this doesn't really matter as much because the interest rate rarely changes as it's set by the Fed and only adjusted either in times of good economy when it's increased generally, or in times of when the Fed needs to stimulate the economy by decreasing the interest rate. Let's talk about implied volatility. This is always written as a percentage. This is annualized as a 1 standard deviation range for the stock based on the option prices. So keep in mind that the implied volatility is based on the option prices. Okay, let's just do a quick example. And I found this data on Yahoo Finance, and you can look up the option change for any symbol and get lots of free information. This example is for an Apple March 13th $300 call. The implied volatility is 41.28% based on this call. And so you'll see that because it's based on the option prices, depending on the actual option itself, the implied volatility will be different. Okay, so if we round a little bit, the standard deviation would be $125 because 41.28% times $300 is approximately $125. That means that there's a 68% chance, 1 standard deviation, that Apple is between $175 and $425 in 1 year. As you can see, this is a very wide range. So keep that in mind when you're thinking about how much this option is implying that the stock will move in this short of a period. If you expect it to actually move more than this, that would be something you might consider buying. Additionally, there are about 250 trading days in a year. So you can calculate the approximate implied volatility per trading day by taking the total implied volatility and then dividing it by 250. You can then use this information to figure out how much the stock is expected to move each day. Okay, I'd just like to take a second to talk about finding the Greeks. You can find the Greeks with your broker. For example, Robinhood, E-Trade, TD Ameritrade, things like that. They will provide them for you. Or you could use a theoretical calculator online. Theoretical calculations also allow you to estimate when you can sell the option for a profit. They'll give you inputs like days left to expiration and stock price, which you can change that are variable, and this will allow you to estimate the value of an option. One example of this is optionprice.com, and this is free. As you'll see on the next slide, theoretical values aren't exactly the same as the actual trading values, just like stocks aren't exactly traded for the same price that they're necessarily worth. But they're a pretty good approximation. All right, let's do one example calculation. The Apple March 13th $300 call value. The actual value is $5.45. We're talking about the call that's highlighted on the bottom of the screen. This data is based on the Black-Scholes option pricing model. And although there's a few other options pricing models, this is the most common. This is an example of a theoretical calculation that I used Schwab Street Smart Edge, which is a platform for my broker, to calculate. But again, this similar thing can be done with many other brokers or an online site. And generally, you'll be able to see the 5 main Greeks, which are enough for you to determine how the price of the option will change over the course of time. So as I covered before, the actual value is $5.45, which we can see down here at the last trade. The last trade is generally a good indicator of what the value is. The theoretical value is $5.34 based on the Black-Scholes model. As you can see, a lot of these options would be somewhat changed. They're somewhat high. The actual value of the option, the last trade of the option, is somewhat higher than the theoretical value. This is not super important. It may suggest that the options are slightly overvalued at the current prices, but it's not very important. The important thing is that this can tell you the theoretical value. If I were to change the days past, the IV change, or the price of the stock, that would change the theoretical value of the option, allowing me to estimate how the value of the option would change at a certain scenario in the future. Then these Greeks can be used for you to figure out other things. As we covered how each individual Greek affects the stock price, they will be calculated in the model to figure out what type of stock price you could expect. Additionally, you can keep in mind the Greeks and the theta. So you can see, for example, for the $300 Apple call, the theta and delta are very similar. This means that in order for you to not lose money on theta alone, which is again the DK in options price for every 1 day, Apple stock would have to go up at least $1. This is important because it shows that if you're buying this option, theta is working against you, and so the option price has to, so that Apple has to increase in value for you to even make money. Okay, now if you think about using the Greeks, calls have a positive delta and puts have a negative delta. This is just a fancy way of saying that when the stock price increases, the value of a call increases because it has a positive delta. And puts have a negative delta, which means that when the stock price increases, the value of the put decreases. And when the value of the stock decreases, the value of the put increases. Next, one important thing to consider is theta. When you're buying, theta works against you because every day that passes, there's a smaller chance of the option expiring in the money and going in your favor. When you're selling, this actually works for you. The reasoning is that the less chance of an option expiring in your favor or in the money would actually be good for you because you're selling the option, so you don't want it to expire worth anything. Another important thing to keep in mind is IV crush. This is generally after a large event, like reporting earnings, and then the implied volatility will decrease substantially, and so will the option price, not the stock price. So generally, this is important to keep in mind because if you have, let's say, an $80 call on a stock that's trading at $70, and that stock beats earnings, let's say it goes up to $75, the delta will increase the value of the stock because the dollar value of the stock is increased, causing the value of the option to increase. However, the theta will decay and the substantial decrease in implied volatility, because now there's no longer that event which could cause volatility, will decrease the value of the option. So to make money, your gains from your Greeks must offset the loss from the Greeks. So this is important for you to know, because remember last video I was talking about how most people don't actually exercise options. Therefore, this is very important to understand, so you can figure out where the price needs to be for you to make money by just simply selling the contract and not actually exercising it. Thanks for watching. The next video we're going to be covering option strategies and how the Greeks impact them.